The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm welcome to Squawk Box with Karen Cho and myself, Steve Sedgwick, and these are your headlines. President Trump has announced potential plans to, quote, take over Gaza and redevelop it during a state visit by the Israeli Prime Minister.
I do see a long-term ownership position, and I see it bringing great stability to that part of the Middle East and maybe the entire Middle East.
Chinese equities trimming gains after reopening from a week-long holiday, with investors reducing risk after Beijing's swift tariff retaliation.
Investors turn cautious over Alphabet's big AI spend after the Google parent company announces a whopping $75 billion investment in the sector this year, far exceeding forecasts.
Novo Nordisk gets to report their full-year results, with investors showing anxiety over the stock in recent times. We'll have the chance to speak to the CEO later this morning.
And Ferrari shares accelerate after the luxury car maker beats full-year forecast and flags further growth this year. But the CEO tells me the impact of tariffs is still uncertain.
We do not want to impact only one of the three players who will manage. Let's wait when this is becoming a fact.
A very warm welcome to the show on what is a stunningly packed day on the corporate news front, on the economic front, but mostly on the geopolitics as well. Let's get straight into the latter. President Donald Trump has said the US will, quote, take over the Gaza Strip, saying Palestinians currently living in the enclave should leave and be placed in other Middle Eastern countries, whilst the US develops it. Dan joins us with more. Dan, we've seen some extraordinary suggestions of how to solve the conflict in Gaza, the conflict with Israel, and how to make long-term plans for Gaza. I don't think in the years where I've been studying geopolitics, I've ever seen anything more extraordinary than the potential plan from Donald Trump. I have to ask you, do we think he's serious?
Well, Steve, I'll use the word that you used, stunning. It was a stunning proposal from US President Donald Trump. He's suggesting that the United States take ownership of the war-torn Gaza Strip and turn it into what he calls the Riviera of the Middle East. He was speaking at the White House, of course, alongside the Israeli Prime Minister Benjamin Netanyahu, the first foreign leader to visit Trump since he's taken office. And he outlined this vision to redevelop Gaza, or essentially relocate its population and create what he described would be thousands and thousands of jobs. Listen to this.
I do see a long-term ownership position, and I see it bringing great stability to that part of the Middle East and maybe the entire Middle East. And everybody I've spoken to, this was not a decision made lightly. Everybody I've spoken to loves the idea of the United States owning that piece of land.
We're talking about it. He's exploring it with his people, with his staff. I think it's something that could change history, and it's worthwhile really pursuing this avenue.
So for his part, the Israeli Prime Minister there did not explicitly endorse Trump's plan, but he, of course, also said it was worth pursuing and, of course, aligns with Israel's goal of ensuring that Gaza never poses a threat to Israel again. But of course, as you would imagine, we've been canvassing the reaction across the region. This proposal is already raising major questions about Palestinian sovereignty, about the legality of this, about regional diplomacy moving forward. The president there, of course, not really clarifying how such a significant move would be carried out or under what legal framework, but he did also insist that US control would bring long-term stability to the region. That's already been firmly rejected by Saudi Arabia, who said, of course, the Palestinians need a state. That's something that they've been sticking with for a long time now. It's something that US lawmakers have also called deranged, at least some US lawmakers in reaction to this. Of course, earlier we heard the president floating the idea that Palestinians could just be pushed to Egypt and Jordan as potential destinations. They don't want to go there. Those countries don't want them either. So to the question of, is this real or not? I think it remains to be seen. We know Trump is a negotiator. He likes to go for the most controversial position first to extract concessions from stakeholders. I've spoken with one former Netanyahu advisor this morning who says that may indeed be the case. But of course, we have to watch and wait to see what happens next year.
Yeah, Dan, thank you very much indeed for that. And as you're canvassing opinion in the Middle East, we'll continue to canvass opinion from the geopolitical experts we get on the channel, but quite extraordinary. OK, let's move on. Chinese markets have reopened for the first time this Lunar New Year, with traders digesting a tumultuous news flow. In the week since markets last traded, global AI-related stocks suffered a DeepSeek-related sell-off. President Trump announced tariffs of 10% on Chinese goods. The White House targeted Temu and Shein by looking close at the de minimis loophole. It's absolutely fascinating, that as well, and it's something other countries I'm sure are looking at as well. Anyway, Beijing retaliated against the US by launching its own tariffs on American goods. Meanwhile, a private survey showed that services activity unexpectedly fell, but remained in expansion territory at 51. Karen, I think it's fair to say that the world is moving at a very fast pace.
Indeed, and a lot of that news flow around tariffs would be naturally risk off for the Chinese markets that have been shut for 6 straight sessions. But the DeepSeek news, that puts some risk back on the table, because the AI adoption, what it could mean for Chinese tech companies and Chinese corporates more broadly, is a positive story. And you're seeing that counterweight in the Chinese markets today. Having somewhat of an impact has been this news flow that the US Postal Service is temporarily suspending inbound parcels from China and Hong Kong. That is the Shein and Temu effect, and just what impact that has on those e-commerce players in China. So what you're seeing for some of the markets, it is a mixed picture. Shanghai composite down. We've got the CSI 300 also sliding, but elsewhere you are seeing the Shenzhen market climb slightly. That's where the tech-heavy stocks are located. Chinese property names and the impact that we're seeing on those names, they are down. So you're seeing Vanke slide more than 5%, and other major developers also give back territory. Those Chinese tech players, we've seen a feature of it on the Hong Kong market in recent days, where EV players have had a little bit of steam. They've picked up some action around some of those tariffs around the North American market that could seemingly upend the state of play for autos. But of course, the Chinese retaliating too on big format cars, pickup trucks from the American economy. So the picture is a little bit mixed for some of those tech names, and this is how it looks so far across on some of those tech stocks this morning, Steve.
Thanks, Karen. Let's get to Sean Rain, who is the founder and managing director of China Market Research Group. So lovely to see you, Sean, and lovely to see the subtle hint about your book over your shoulder. No one would ever know you had a book out looking at that. But that aside, Sean, go on, Sean.
Last time we talked, you said you were going to go to Waterstones and pick up a copy. So if you did you like the book?
It's true, I did say that. And it is also true, I haven't fulfilled my promise to you. Sean, do you know what? I haven't got an Audible in the car for the 3.5 hours driving I do a day. I will do that now. If I haven't done it by the end of this interview, if it is on Audible, by the way, I will eat my hat. There you go. Sean, tell me about the Chinese New Year and the consumer. It's still weak, yeah?
Well, happy Chinese New Year. It's the year of the snake. So that's why I'm wearing red, because I'm a snake baby and I need to ward off the evil spirits. So wearing red does that because there are a lot of evil spirits around. What we found, Steve, during the Chinese New Year period was that consumer confidence was really bad. What happened was Chinese New Year bonuses were weak, and a lot of companies that we interviewed, they said last year they gave 2.5 months as a bonus. This year, only 1 month. So there was a lot of muted happiness. People were still traveling, but they weren't spending as much money in 5-star hotels, and they're spending much less money going out to eat in restaurants. I'll give an example. I was in a 5-star hotel where they charge $40 to go to the club lounge at night. I have never seen so much mayhem in a hotel in my entire life. People are spending that extra $40, bringing their entire families there so they could eat a buffet of rice and noodles because they just didn't want to go to the hotel restaurant. So I took my family to the hotel restaurant, completely empty. So investors need to be cautious. The Chinese New Year sales are going to be much below expectations. It's going to be quite negative. People are scared because of their weak income, Steve.
Sean, that is certainly a warning, isn't it, to the consumer stocks here in Europe and that are linked to the Chinese market. Can I ask you about the impact of DeepSeek? Because we are seeing that as a feature where investors are saying, look, the Chinese have got this cheap technology. We've already got major tech companies from Alibaba to Huawei using the leverage of DeepSeek. What does that mean for the animal spirits and whether the Chinese get going? Because they've got this terrific technology that can drive huge efficiencies and potential returns.
So that's a great question, Karen. So the numbers coming out are going to be really weak for Chinese New Year, but actually the last few days, Chinese have gotten happier because of DeepSeek, because of the success of Xiaohongshu or RedNote. There's a feeling amongst Chinese, especially the movers and shakers, the people who start companies, the people who invest in companies, that, you know what? The crippling, crushing sanctions from the United States onto China didn't hurt DeepSeek, didn't hurt Alibaba's AI app. So maybe there's an opportunity to regain those animal spirits and start to build up new companies again. That's why actually in the short to medium term, I'm actually quite bullish on Chinese equities. I would be getting exposure to Alibaba. I'd be getting exposure to Meituan, because for the first time in 3-4 years, the 10%, the wealthy Chinese feel there's a way that the Chinese can overcome American sanctions. You look at it, Eric Schmidt, the former CEO of Google, he used to say that America was 10 years ahead of China in AI. Even just 6 months ago, he said that America was 2 or 3 years ahead. Now we've seen DeepSeek is as good as ChatGPT, maybe even better, and they did it at a fraction of the price. Also, another thing, Karen, is investors should look at Yangtze Memory, should also look at SMIC or SMIC. I think the indigenous innovation is really going to be a hot spot over the next 3 to 6 months.
That's a great point, Sean. I was looking at a Xiaomi announcement as well around a Chinese car, so homegrown innovation. What do the tariffs do, though, at this point? Because we're seeing a bit of the tit for tat from the American tariffs to response from the Chinese. How does this impact the Chinese market?
Yeah, it's kind of surprising. You saw Rand Paul, a Republican senator, and Chuck Schumer, a Democrat senator, scream and criticize Trump for the tariffs on Canada and Mexico, but they've been silent about China. So anything against China is okay in the United States. And so Trump slapped his 10%. But you know what, Karen? There was a sigh of relief in China because it wasn't the 60% that he had been talking about on the campaign trail. And China's state government, the state media, has actually been muted in their response. They haven't been as vindictive or angry against the United States as they were in 2017 when the trade war started. What they've basically been saying is we need to protect our sovereignty. We're going to add 10-15% tariffs on liquefied coal, on LNG, and on tungsten. But I think importantly is these are fairly small areas. They only account for about $22 billion of imports. Also, tungsten is not a rare earth. So China didn't use the nuclear bomb by saying they were going to restrict more rare earth elements, which the United States and Europe needs. So from the Chinese view, their response has been muted. The attack from Trump wasn't as big as they were worried about. And that's another reason, aside from DeepSeek, aside from the rise of Xiaohongshu, that the tariff war, at least so far, isn't as bad as expected, which is why I think you're seeing some happiness in the Chinese markets.
Sean, I've got time for a very quick last question as well. You talked about the Chinese were ready for the attack from, or the tariffs from Trump, and they've responded accordingly as well. Has anything that this administration has done or is about to do you think, changed the medium-term outlook of the Chinese? Because one thing we do know about China and the Chinese Communist Party, they think in the medium to longer term rather than the very here and now.
I think two key things, Steve. First is Trump doesn't seem like he's going to protect Taiwan if China launches an invasion. So the threat of military combat has really dissipated or been diminished greatly. And then secondly, very importantly, Trump has said, I don't want China to export NEVs into the United States. I want them to build factories in the US, hire American workers. That's very fair. That's reciprocity. That's what the Chinese made Volkswagen, Ford, and Buick do when they first opened up in China. They made them set up factories in the China market to create jobs for the Chinese people. It's very fair if Europe, it's very fair if the United States does the same thing.
Sean, we're going to leave it there, but not before I show Karen something on set. Karen, can you confirm that I have purchased a listening version of Sean's book?
It says The Split and there's one credit, yes.
Yes. Sean, you got 10 seconds to reply. You now have
Thanks
a
so much,
huge
Steve.
sales
Enjoy
here in
your
the East Sussex area.
I owe you so much. Happy New Year, both of you, and to the audience.
Indeed, thank you. It would have been nice if I got a free copy, but there you go. I have bought my own. I bought my own. Thanks, Sean.
Maybe it'll be a year of good fortune for you. So,
to be fair, I've just finished a recommendation from another one of our guests. Yes. And so I'm very happy to move on to another one as well. So it's great. Thank you for that, Sean. Meanwhile, the president, Mr. Trump, is pursuing tariffs against China, as we discussed. He's paused hitting Mexico and Canada with 25% duties for 30 days. Speaking to CNBC, the Canadian prime ministerial candidate, Chrystia Freeland, of course, former minister in the Trudeau government, said it was important for negotiations between Ottawa and Washington to bear fruit.
We want a great relationship with you guys. We think we have a great relationship with you guys. But if you hit us, we will definitely hit back, and that will make a really dumb idea even dumber. What we really need now is to get to a place where the tariffs are definitively off the table, because as long as that threat is hanging there, it's bad for everyone.
We were just hearing from Sean then about the impact on Chinese companies really pushing ahead with their own technology. And we're just about to talk about Apple and how it's trapped up in tariffs. But where's the Apple car?
Oh, that's gone years ago.
We never got it right.
No.
But there is a rival to Apple in the Chinese market, in the smartphone market, and that is Xiaomi. Xiaomi has gone aggressively into the car market now, and it's talking about releasing a very upmarket version of the SU7 Saloon. So this is a competitor to Tesla and even the Porsche. High-end Porsche.
Wow.
So fascinating, isn't it? The level of innovation you're now seeing from these companies that are big in one area in technology, taking it to the next level. So
it's the Tesla model, isn't it?
Well, tariffs being cut off from the West, is that actually encouraging them to go faster and harder because they're cut out of core markets where they could have just had volume in their existing business?
There's a billion Chinese out there, and a lot of them want luxury cars, and they won't necessarily care whether they buy a European mark or a US mark, or indeed, if there is a Chinese equivalent, and they'll be very happy to buy that, maybe.
But it says something about changing business models, and this says Apple is facing the latest around tariffs. Now, countries and corporates around the world are working out how to react to Trump's tariff threats. Apple is one big name expected to take a hit from US levies on China, with analysts forecasting an impact on the bottom line. Steve Kovac filed this report.
President Trump's tariffs on China leave Apple with a few options to mitigate their effects. They could raise prices on their products in the United States or just absorb the costs. And another cost-saving move could be to divert manufacturing from China to their locations in India and Vietnam. But none of that is going to be enough to fully mitigate the effects on tariffs. I caught up with some analysts who follow Apple closely. Eric Woodring over at Morgan Stanley predicts about a 3% hit to earnings if Apple can't earn exemptions from these tariffs. Gene Munster over at Deepwater Management, he says about half of Apple's sales are built in China. That includes 85% of iPhones. And for India, just 10% of revenue is manufactured there. That's going to make it very difficult for Apple to move its manufacturing outside of China and bring products from India or Vietnam into the United States. And then, of course, there was the inauguration moment with Tim Cook donating $1 million of his own money to the inauguration fund for President Trump and appearing behind him at the event as he was sworn in. The perception at the time was that this was a gift to Trump in order to get Apple relief from tariffs as it got in the first administration. Still, there's a chance that Tim Cook could leverage his relationship with President Trump and earn exemptions down the road. But for now, Apple is subject to those 10% China tariffs, and that could put an impact on its earnings. For CNBC Business News, I'm Steve Kovac.
Coming up on the show, earnings season heating up with the Google parent Alphabet disappointing investors after missing revenue expectations and spending big on AI. We'll bring you plenty of analysis next. Plus, Charlotte in Maranello as Ferrari posts a 21% jump in full-year net profit. We'll bring you an exclusive interview with the CEO, Benedetto Vigna, later this hour. And we'll be speaking to the Pandora CEO, Alexander Lasik, after the jeweler posts its own fourth quarter results. That's coming up at 7:30 London time. Welcome back. Santander has announced a share buyback program amounting to around 25% of the bank's profits in the second half of last year. Fourth quarter attributable profit rose 11% on the year to 3.3 billion euros. We're going to be speaking to Ana Botín, who is the executive chair of Santander Group, on the Spanish bank's full-year earnings in the next hour. That first on CNBC Conversation coming up at 7 GMT.
In the meantime, a big lot of news flow from tech world as Alphabet shares sank in extended trade after the technology giant missed on fourth quarter revenue expectations and announced further investments into artificial intelligence. Revenue at the Google parent company grew 12% year on year, slightly weaker than the same quarter last year, amid a slowdown in its search business as well as its YouTube ads business and services unit. The CFO, Anat Ashkenazi, told investors that expanding investments into AI is a priority.
As we expand our AI efforts, we expect to increase our investments in capital expenditure for technical infrastructure, primarily for servers, followed by data centers and networking. We expect to invest approximately $75 billion in CapEx in 2025, with approximately $16 billion to $18 billion of that in the first quarter. The expected total investment level may fluctuate from quarter to quarter, primarily due to timing of deliveries and construction schedules.
Arjun is here with more. Arjun, looking at the numbers, I wonder whether there is a pre-DeepSeek versus a post-DeepSeek trade on this stock. For instance, if it had to produce the same set of numbers today without DeepSeek producing credible technology with an M instead of a B, whether we would have had a very different reaction in after hours. Because, you know, one of the numbers here on Google, the cloud business, 30% rise in its revenue, not the 35% it had in the September quarter. The excuse was that, look, we had the demand, we didn't have the capacity. That would be seen as good news typically.
Yeah, no, you're spot on. And I think going into this earnings season, the big question, the overarching question was, can big tech justify its AI capex spend? And I think when you look at the results from Alphabet, the expectations were clearly high post DeepSeek, and it was just the smallest beat on earnings, the smallest miss on revenue. But what the market wanted to see to justify their capex was a massive beat. And to top it all off, Alphabet saying that capex is not slowing down, committing to about $75 billion of investment in AI infrastructure, servers, data centers, etc., this year as well. And so that was, I think, a little bit of concern as well. But you're right. I mean, the company is saying we have too much demand, we don't need capacity, therefore we need to build that out. But had that been before we heard the DeepSeek efficiencies on their model, that clearly would have, I think, been a different story at this point. I think the other concern here is the cloud business. Whilst there was growth, revenue was just under $12 billion, missed expectations as well. And this is, again, a bit of a downside because this is the area in particular, cloud, where the market wanted to see the growth to justify that spend.
So if we're all sitting here trying to work out whether the AI spend is going to be justified, there is one piece that does make me somewhat cautious. And this was around the new feature. If you've ever used Google in recent times, you get this new summary at the top of your search. And this is effectively what they call AI overviews. And the comment here was that there's been a lot of interest for it and search revenues are up 12.5% as a result. But the monetization rate on these AI overviews, which was introduced October last year, is the same as traditional search ads. So they've got to build it because there are rivals coming, Perplexity and beyond, OpenAI or ChatGPT. But they're not getting any more for what they're doing, which is still their usual business.
That's right. I mean, they're not getting more on that front. Those summaries you see right at the top sort of summarize various information from articles. But I think what's going to be key for Google is Gemini. So their sort of AI agent product, I was playing around with it yesterday, it's a very interesting product, is how they manage to monetize that. There is a sort of advanced paid for tier, there's a free tier as well, but is it enough to justify? So I was using it and I thought, well, I don't really need to pay for the upgraded tier at this point because the uses aren't quite there yet. So building that out is going to be key for I think Google to justify. I'm not sure they're going to be able to sort of eke more ad revenue out of summaries on standard search, but these other products I think is where they're looking to monetize AI.
Very interesting looking at what the Chinese news was in the last 24 hours and whether there is some form of monopolistic activity surrounding Android as well. But Google is a monopolist, and it has acted as one to maintain its monopoly. That was a US judge last summer as well. Change of administration, has that led to a change of impetus regarding the breakup story on Google and Alphabet?
The broader view is that the breakup story will sort of calm down somewhat, I think, under the Trump administration, under a different administration. I think that seems to have slightly dissipated. Hard to tell in the first few days of the presidency at this point. And that could all change very quickly, have we seen. But so far, it feels like big tech is emboldened. They don't feel as threatened by the regulators at this point. But again, as I said, that could change overnight, as we've seen with this administration.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.